Good evening, ladies and gentlemen. Myself, Daniel, representing PMS Bazaar. I welcome you all to the MK's Alpha Mavens, the fourth episode of season 2. Our guest speaker will share his insights on the topic, the new gen ultra HNIs and evolving advisory space. On behalf of the participants, I welcome our guest, Soumya Rajan from Waterfield Advisors, Vikaas Sachdeva and Sachin Shah from Emkay Investment Managers. Before I hand over, let me give a quick introduction about the speakers. Soumya Rajan, founder and chief executive officer, Waterfield Advisors, India's largest independent multifamily office and wealth advisory company, and brings over 25 years of experience in financial services. She started her career with Greenleaf Bank and spent 17 years with the bank, working in both India and Singapore, and was heading the private bank division in India before founding Waterfield in 2011. At Waterfield, Soumya advises several of India's leading business families on their global investments, issues related to succession and the continuity of their family enterprise, corporate and family governance, business strategy, and philanthropy. The company presently advises on global assets of $4.3 billion and is one of the most awarded wealth management firms in the country. Soumya was featured in the Forbes India Women Power List 2021 and was awarded Outstanding Private Banker Asia Pacific by Private Banker International in 2021. She is one of India's top 100 women professionals in finance. Soumya was awarded the Radhakrishnan Scholarship to study at Oxford University, UK, where she completed her master's in mathematics and hold a BA honors in mathematics from St. Stephen College, Delhi. Vikaas Sachdeva is a chief executive officer and at Emkay Investment Managers Limited. Vikaas is an industry stalwart with over 2 decades of experience across marquee financial organizations. Vikaas was the CEO of Edelweiss Asset Management Limited, the global CEO of Enam Asset Management Limited, one of the founding member of Birla Sun Life Asset Management Company, among others. His industry affiliations include a seat at the Mutual Fund Advisory Committee, and he was also on the board of AMFI, heading the ETF and Indexing Committee. Sachin is a seasoned fund manager with over 2 decades of experience in the Indian equity markets. Sachin realized the importance of governance and was instrumental in the development of Equal Risk and MK's proprietary module, which helps the company to evaluate and compare listed companies on various aspects of governance. And also, I like to thank Finland Academy for their prize to the best questions, which will be announced end of the session. Quick note about Finland Academy. Finland Academy is a trading and investment education initiative. It is a research-driven, technology-oriented training organization focused on providing a dedicated education in trading and investment-related subjects. So without further delay, I'm handing this session to Mr. Vikaas and Sachin. Over to you, Vikaas, sir.
Thank you so much, Daniel. I'm always tempted to also introduce PMS Bazaar without realizing that we're actually on the platform of PMS Bazaar and needs no introduction. But this has been a wonderful platform. And I'd just like to inform the viewers that, this is probably the first time that this show has crossed 750 registered users for this show. Full credit to PMS Bazaar and, of course, our guests. Talking about a guest, I think it is, as always, my privilege to introduce the person behind the professional. And Soumya, I must tell you that I've been talking to a lot of your colleagues, your ex-colleagues, and there's so much of goodwill that you have amongst your peers, your team members. In fact, while I was talking to some of your peers, one of the statements which came about was, since you're arguably the first woman founder of a national wealth advisory firm in India, they refer to you as the first lady of the wealth advisory fraternity, which I found very sweet. So congratulations for that. Your colleagues and your ex-team members also talk about you having a very strong value system, a very strong belief system, and trust is the basis of every decision taken. You have a lot of pride in the Indian culture. In fact, your vision is to take Waterfield and to create a company which is a global company with Indian roots. You have an amazingly keen eye for detail. Your colleagues are both amazed as well as a little distraught by the fact that you can pick out facts, data, colors, fonts out of nowhere. You have an amazing sort of attention to detail, and you're very particular about what you want. Have a high degree of personalization and customization attached. Well, this was also a surprise to me. You're a trained classical singer and you sing quite well, but simultaneously you have a soft spot for soft rock as well. You love karaoke and are a major fan of Marvel movies and Netflix. And actually, that makes two of us. If it were not for financial services, you would probably have been into interior designing. You love interior designing, and people who've been to a vacation home in the Nilgiris describe it as exquisite, classy, and out of this world. You're a very emotional person. In fact, the name Waterfield for your firm is a throwback to your first job at Brindley's Bank, Waterfield branch in Bandra, and that's your way of paying homage to this thing. Your way of So I asked a lot of people, सौम्या राजन को गुस्सा कब आता है, कैसे आता है, क्यों आता है, क्या करती है सौम्या राजन? I was trying to say. So apparently your way of bringing about discipline is quite unique. You do not raise your voice, but you're unabashedly honest, quote unquote, about your feedback, and people do get the point. You love sweets, have learned the salsa recently, and you aspire to write a book someday. But this is my favorite one. You love cricket, and Rahul Dravid is your favorite cricketer. And you really, really, really want to manage this portfolio. Okay. Last but not the least, you're a workaholic. You love Thai food and one day aspire to have homes and offices in New York, London, and Mumbai. So, sort of an amazing, perspective about you at a personal level. I thought I should bring it to the audience at large.
Thank you so much, because I'm quite stunned and very flattered by all that you've said, and of course delighted to be here today.
Thank you. So let us just dive straight in. Let's set the context. How would you define this segment, new age ultra HNIs, as the topic goes, and how different are they from, say, vintage ultra HNIs, if you could term them? In your view, how are they different?
So I think the best way to think about the ultra HNI group or segment is when you define the new age ultra HNI, it is somebody who is like a founder who has just had a liquidity event, who has come into money and then trying to figure out, what happens with that wealth from this point on. The vintage ultra HNI, however, in my definition, is really more like a family business, where it is multi-generational, and therefore it is not a single family, but it is multiple generations in that family. What's interesting about both these two is really the way in which they approach wealth management and how they look at investing. So when you have the new age founder, they have just come into liquidity. They're very keen to actually test everything that's out there, because they've never had the experience of having money which they can invest. So they end up speaking to lots of different wealth managers, trying to understand what is the field out there, and then zeroing in on who they ultimately want to work with. Whereas in the family business, you're always dealing with multiple generations. You're dealing with the founder who traditionally always has a higher risk appetite because they have founded the business. And when you get into the next generation, which is like the siblings, you find that they are then looking at a very different kind of risk appetite, and similarly for the next gen. What I've normally seen, Vikaas and Sachin, is that ultimately when you're looking at both these two, it's about understanding what is business risk and what is investment risk. So if you look at, let's define the vintage ultra HNIs, which is family businesses. The founder typically has high business risk, but very low investment risk. On the other hand, the moment you move to the siblings, you've suddenly got a moderate to, they want to keep the business kind of afloat. They don't want to do anything to rock things. But on the investment side, it starts moving from a low risk to low to moderate kind of risk appetite. And by the time you get to the next generation realizes that 2 generations have passed. On the business risk side, chances are that if they don't do something, the business may actually sink. And therefore, there's a higher business risk element that comes in because they need to innovate to keep the family business alive in some sense. Interestingly, their investment risk for the next generation also increases because previous 2 generations have actually saved capital. You've had a bit of family office wealth that's got created. And their wealth is actually, they look at more to a moderate to high kind of risk appetite, and much, much more open to newer investment products. So whether it's an unlisted, whether it's an impact investments, they look at that space. So this is on the vintage side. And certainly in the case of the new age founder, they are completely at sea because they've just come into wealth, and every single wealth management company is calling them up and asking them, I can manage your wealth and I can manage your wealth. And everyone is saying that they are the best wealth managers. What I try to do with my clients is to say, pause, do not be in a hurry to invest, just understand what's out there, feel comfortable with whoever you're going to work with, and then go about working with them.
Wonderful. You actually mentioned the word comfortable. And I think this is something which I've often found when I keep dealing with people, that for almost everybody, comfort is more important than conviction.
It is.
You've just described it beautifully. So coming to these new age ultra HNIs, you did mention about them being at sea and they run into wealth. Quite a few people I've spoken to, they believe that by virtue of the fact that they've created wealth from the startup system, if I have to put it, paraphrase it, they prefer investing back in the same ecosystem rather than moving towards conventional investment avenues like listed equity. Would you agree with that analysis? What's your take on that?
I would agree. And here I'm going to look at it from the entrepreneur's lens. And that's really because as an entrepreneur, you know how much you have struggled to get to where you are. So the moment you do have capital, innately in your mind, you want to be able to support and help that ecosystem, which really nurtured your own success. So it is very much about giving back. It's almost like the way I would give back towards a philanthropic cause, because I strongly believe in something. By the same lens, the entrepreneur wants to give back to their particular ecosystem. And this is quite natural and something that I would even encourage, because ultimately you want to be able to fuel the entire entrepreneurial ecosystem. No one better than an existing entrepreneur to actually fund a company, because they're also not going to ask for a whole bunch of onerous, huge affirmative rights and a whole bunch of things that come when you take external capital or third-party capital. So I think this ecosystem can be very, very self-fulfilling. And certainly all the entrepreneurs that I meet, one part of their capital is very clearly earmarked and allocated towards their particular area of interest. So very common.
Very interesting. Very interesting. Sachin?
Yeah. So Soumya, actually, we're talking about the startups, and incidentally, you are also a startup. You are the first lady who's on our show. So, we are in an era actually, in an interesting trend where we are seeing a lot of women co-founders, and a lot of them very successful, right? Whether we look at Ms. Nair of Nykaa, whether we look at Vandana Luthria, so I'm saying across sectors, or whether we look at Ms. Kiran Mazumdar, and of course you, right? So, obviously women now have a decent amount of wealth to think of, right, for themselves. So how do you approach this? Is there something different, like when it comes to women wealth, or say like the family wealth? Is there some unique different approach would you have? Or how does it work? How do women think?
I do think there is some unique facets about women in wealth. And that's one of the things we try to actually address at Waterfield through a proposition that we have called Women of Wealth, where we're trying to really cater to women entrepreneurs, women professionals, as well as women inheritors. What's a little unique about them is that, one, I think the industry by and large has not been very good in addressing the needs of this segment, because they've often said we have a proposition for women, but they really don't deliver on it. It's more lip service than necessarily what they deliver. What I found is that I believe needs to be defined in a good women's proposition is, the first is that do not take for granted that financial independence is actually financial literacy. Because financial independence, a lot of women may be working, they may get their salaries, they may be getting their dividends or otherwise, they may have inherited money, but inevitably they're giving it to somebody else to manage. So while they are financially independent, they're not necessarily financially literate. So I think that's one big issue that needs to be addressed around literacy. The second is around networking. Most women very, very hesitant to network. Sometimes you have to if you have to raise capital, you have to network. You can't be just sitting somewhere in the back and saying that, look, I'm going to wait till somebody comes to me and says, you've got a great company and let me invest. You really have to get out there in front of venture capital, private equity, and otherwise. And that women can sometimes find quite intimidating because they're really not into, hobnobbing and, going out for different social engagements, trying to pitch their case. So networking, I think, is another very important piece. And the third is really around wealth with a purpose. Most women, you will find, look at their wealth, really trying to see what is that wealth doing for them. Is it about educating their children? Is it about a family foundation? Is it about just setting up their own business? Each of these, the wealth necessarily needs to have an outcome. It's not something which is just there just to be managed, almost like a fund manager, unlike your role, Sachin. It's more about, what is that money going to be used for ultimately? And in the interim, how am I actually going to invest that? So the women of wealth proposition, I think, has to be redefined for most wealth managers out there. They need to really relook at this space. And for us, of course, it's about even the delivery of the service. Can it be with women? Can it be that so when in our proposition, we're very clear to say women at least will be one of the elements who service you. It can be your RM, it could be your service manager, it could be your operations person, whoever it is, it could be your investment manager. But one of the elements would be a woman as part of that institutional outcome for the client.
Fantastic. Those are really very comprehensive thoughts, if I can say. The other one interesting trend that I've been observing is that we keep on reading in the newspaper headlines also almost every fortnight that the ultra HNIs are moving their wealth, at least some portion of their wealth, and with the liberalization from the RBI side to the overseas investments. How do you see these trends, and what are they really thinking? In fact, we've also been reading that some of the families really want to relocate, and obviously when they're relocating, they'll think of moving a substantial part of their wealth out there. So what are the trends out here, and how do you approach your investors? Because I'm sure a lot of investors or your clients would come and say, what are your thoughts of me investing abroad or, moving some wealth outside India? So, or making it more global. And we also saw last 5 years, US markets did wonderful last 5 to 10 years compared to most of the global markets. And of course, now dollar is appreciating. So I'm sure these are questions which keep on coming to you. How do you approach this?
I look at it far more simplistically, which is really around the diversification of your investment portfolio. So one part of it is really that you shouldn't have all your eggs in the India basket in the longer term. So what you want is just the geographic diversification that happens. So it's important to be able to take that international exposure, whether you do it through rupee denominated products or whether you do it through LRS. Over the last 2 years, we've been very, very, very adamant actually with our clients to say you've got to look at an international exposure. And we did it very successfully through rupee denominated products so that it really didn't come into the LRS piece. And of course, where LRS is concerned, India does have capital controls. So you do need to make sure that you dot the I's, cross the T's in terms of any investment that they're making overseas. But fundamentally, you do need that international exposure. I think the other point is really around the fact that when COVID did happen, there were a lot of families that did feel that perhaps whether it was around the medical infrastructure, whether it was around just basic infrastructure for them to lead a better quality of life, maybe India was not up to the mark in certain instances. And therefore, they felt that they at least needed to have perhaps one leg out of the country as well. That's one of the reasons why we've seen a lot of Indian families have become global Indian families. Also because they're now thinking about their businesses from the global lens as well. So the way I look at it is that we will have to address both. We will have to address one where we can, through rupee products, get international exposure. And the other is really to cater to clients who are global Indian clients. When Vikaas made the reference to the fact that Waterfield wants to be a global company with Indian roots, it's really because we have to follow our clients. If our clients are beginning to move to other jurisdictions, we cannot be staying just in India because somebody else will then manage their wealth outside. what is Waterfield's ambition? I would love to be able to be the equivalent of a Credit Suisse or a UBS for global Indian clients or clients globally going forward. They may have originated out of Switzerland in the years past. Why can't the future belong to companies that emerge in the services sector out of India?
Great. So just one thing, I'm going to touch a little bit on this.
Sure.
You did mention, yes, that it's important to diversify and go outside India, which is good. I understand. But there is also one rule of investing: only do what you understand, right?
Yeah.
So then the question that I have is that, do Indian wealth managers or even fund managers, have they been able to upskill themselves to understand the global markets and invest there? Have we made ourselves capable of doing that today?
So great question. I think we have to upskill ourselves, and I don't think that we are completely disconnected in India. I think there's some wonderful investment professionals out there who really understand global markets. A lot of what happens in Indian markets is because of what's happening in global markets.
Sure.
So if we don't understand that, there's no way we're going to be able to interpret India as well. So I think it's a lot more linked than we think. And if we don't understand both sides of the coin, global and India, then we're not going to do justice to our wealth. But I'm happy to actually see that more investment professionals are talking the language of not just India, but outside India as well.
Great. Thank you. Vikaas, over to you.
Sachin, for a second, I thought you were going to preempt my next few questions, but thankfully you did not. But Soumya, since you have been a pioneer in this business of wealth advisory, a lot of people out there are still not very clear how wealth advisory firms are different from wealth management firms. They're very curious about to know the value proposition a firm like yours offers. Would you be able to elaborate a bit more on that?
Yeah, absolutely. And I think when we started the whole wealth advisory journey, for me, it was about not having a conflict of interest, because that we should be able to advise a client irrespective of where the product did sit. So for me, it was, if I was earlier in Standard Chartered and there were a bunch of products that Standard Chartered approved, based on where I was, I could only showcase and work with the client for a limited set of products, whereas there could be other great products which were sitting outside. And that was really the thesis behind starting Waterfield, because I wanted to be able to say that, look, we can find the best product for you in terms of wherever it is sitting. And we should be able to pull that product into your portfolio irrespective of where it is. So that ultimately it's a win-win for the client. You as the advisor know exactly what the asset allocation is, know what the financial objectives are, and you're able to go to different product manufacturers and pull that product. But if you were to look at the advisory business model just a little deeper, what is it that we're trying to say we give to a client? One is, I think, access. And how could we be judged going forward is really to say, am I able to provide you access to a product which in the normal course you are not getting access to because it's not going through the distribution route? And the second is really, am I able to get you that product at a lower cost of investment? Because I, as a large capital allocator, am in a position to negotiate the fees directly with the product manufacturer. And because there is no intermediary fee, I'm actually in a position to give a better outcome to the client. So when you look at the advisory model, these are the two brand promises in some ways that you are making to the client over time, to say there is access and there is yield and return, which is coming through for the client. But on the other side, you're also saying there is no conflict of interest when I'm actually advising the client. And of course, all the basic hygiene issues of around, is my performance necessarily above the benchmark?
Correct.
All those are, I mean, I'm not even getting into that, because if you don't even get that right, then you shouldn't really be in the advisory business. But I think these are the things that I would say differentiate. No conflict of interest. Can I give access? Can I give better return? That is the brand promise that you're really trying to make from this business model.
In an offline conversation when we were talking, you also mentioned about 6 vectors which you had in terms of governance and all of that. Would that also be part of your value proposition?
It is, because I think one of the things that I've always said is that for a lot of the Indian context, we associate wealth management to be investment management only. We do not look at the broader issues of wealth management around either family governance or succession or philanthropy. These are areas also which are part of wealth management. So when you say you're a wealth management company, you should actually be covering some of this. So at Waterfield, we've defined it as actually 6 different areas that we specifically look at. One will be family governance, one will be global investments, one will be wealth succession and wealth transfer, one will be around your managing of the households, and one will be around the strategic philanthropy area, and one will be around succession planning. So you've got estate planning, succession planning, global investments, family governance, managing households, and strategic philanthropy. These are the 6 areas that you should be covering ideally if you want to be a holistic wealth manager. And that is what we aspire to do at Waterfield, is to really cover these 6 for the client. Investing is just one of the 6 legs that you will actually work on. And that, of course, will include global investments, it will include ex-India listed investments, private investments, in impact investments, and just in terms of other passion investments that clients may have.
Very interesting, because I think more often than not, investment management takes up a lot of, like they say, footage or coverage in the discussion. Very interesting.
Yeah.
You talked about your value proposition and you deal with a lot of family offices, right? So if I were to ask you, when you deal with a family office, what are the top 3 things they look at in terms of a wealth creation process?
So I think very clearly a lot of what we do with them is really around the financial plan and what is the outcome that they're looking for. Because when you look at wealth creation, you'll find for all the different families, they'll have different pools of capital. So one pool of capital will be towards wealth preservation. There'll be another which is really towards wealth creation. So one is to just help them build the financial plan. And when we talk about families which are multi-generational, you're really looking at outcomes over the next 20 to 30 years. I'm really not looking at 3 to 5 years. You're building a portfolio and you're building allocations across generations, because the client in many ways is the custodian of wealth in their lifetime for the next generation. So the way in which you have to also think about the investments is much more long-term. So one of the things that I've found is that if you're looking to advise family offices, you have to work with them on the longer term. You cannot be thinking of, they're not looking at their investments 3 years and 5 years. So the plan itself is much longer. The second is that they're extremely disciplined about their asset allocation. Unlike, what you will find otherwise, if we say that the strategic asset allocation is this, the strategic allocation is exactly that. You may have a movement of around maybe 5-10% up or down. Either you're overweight or underweight in a particular period of time, but fundamentally you are invested across cycles. The other is that most family offices actually view volatility as a friend, because it is an opportunity for them to come in or to get out, depending on which way the markets are moving, in order to say that, I can stay invested or make the tactical adjustments that I would make. So I think 2 big things or 3 big things: long-term, disciplined, volatility is a friend, is how you should look at family offices when you advise them, because this is what they are looking for from their side.
It's amazing, because you would tend to believe that family offices would have a different set of variables governing their wealth creation process, but this is as simple as it gets. It's the gospel truth, and you just need to stick to it. Amazing. This is really interesting. Yeah. Sachin?
Yeah. So, we were talking about the in terms of the success, the overall wealth management. You spoke about some of the tenets, those 6 things. So one of them is, of course, the succession planning, right? And it's a bit complex when you talk about the intergenerational transfer of wealth. Does it get emotional, or is it very objective? I'm sure it's a tough thing.
Yeah, succession is always one of those very touchy-feely areas when you start talking to clients, particularly family businesses. one of the things that I've seen is that, and perhaps the two areas which are the most difficult, which you have to look at, is around sibling rivalry when you're looking at succession, and the other is, well, not to be gender biased, but really it's around the father-son relationship. These are two of the most sensitive areas which can either make or break succession. So when we go into a family, we actually do look at these two aspects very, very closely, because the success of the transition is pretty much hinges on these two relationships. One in terms of how the siblings are interacting with each other, and then what is really the father and son kind of equation. What's also interesting is that, and just to give you an example, what we've seen is that most families, when they look at succession, always want to be kind of equal to all their children. They want to give everybody an equal share of everything, and nobody really wants to play favorites. From my experience, when you keep everything equal, you actually create a problem for the next generation, because there could be some of these people who are involved in the business, and there could be some of them who are not in the business, and everything is about ownership and management. And what you then end up doing is that you've divided everything equally, and the next generation is such that one of them is in the business and two of them are owners, not in the business. And then the one who's in the business suddenly says, hey, why am I doing all the work? And two other people are also getting the benefit of it. So succession is also about not always being equal, and to be able to take some very, very hard and honest discussions with the family. Of course, everything else around trust structures, wills, and everything else are really the formalities. But good communication, having what you want as an outcome very much in place, and having those very, very honest conversations around areas which most people would skirt against, is really what you are trying to do. I think one of the other issues is really mortality. For a lot of Indian families, we never want to talk about, in some ways, death or mortality. Whereas if you are going to have a very sound succession discussion, it has to hinge around the fact that tomorrow, maybe the family principal gets hit by a bus, and then what happens? So it is important conversations. One of the areas that I enjoy working on, because I do feel that, not enough professionals are here to help clients think through some of the ramifications of the decisions that they take in their lifetime.
Perfect. That's cool. The other thing that I have been just thinking, that because now, as you say, that we are seeing a lot of wealth actually getting transferred to the younger generation, because India has seen a humongous amount of wealth creation in the last maybe 2 to 3 decades, right? So the next generation is definitely getting it. Are you seeing any typical trends within them? Like, is the younger generation evolving? We talk about ESG concepts, we talk about impact investing, we talk about ethical investing. Are you seeing that kind of awareness? I mean, we see that in the Western world, at least whatever we read around. But are we seeing that in the Indian families now? I mean, with the younger generation?
I think we are. I think we're seeing it front and center, where the next generation is much, much more conscious that their wealth needs to have a purpose. So while in the earlier discussion, I had spoken about maybe being restricted to women, I think it is also a very, very important subject as far as next gen is concerned. Interestingly, Waterfield, we actually did a study on impact investing in late 2021, because we were getting, these various ideas that kept coming to us from clients, and we really didn't know how to go about this. And we had to first understand, where is the family office as far as impact investments is concerned? How are they thinking about this space? So we did a study in partnership with the Impact Investor Council of India, and we kind of interviewed 83 different family offices in India. And what we found from that is that half of them are keen on impact investing and believe in it very strongly. The other half just don't believe in it at all and don't want anything to do with it. They said, give me my commercial returns, I'm absolutely fine with that. But also, one of the reasons is, why is it that they were hesitant to actually make impact investments, is because the impact was never well articulated. We are very good at saying that, this is the financial return, this is the reason why we're doing X, Y, Z, this is the performance and so forth. But the moment you get into areas like, has the income of the farmer moved from X to 2X, or has the crop yield improved X to 5X, we're not able to measure that. And because we're not able to measure and then articulate it, people are then very hesitant to actually put money into an impact investment. So the way at Waterfield that we define this is really what we call sustainable development capital. And ultimately, sustainable development capital is of two types. It is money that goes into your philanthropy and your charity, and those which are just donations and grants. And there is the other, which is what we call this entire space of blended finance. And blended finance, impact investments is one part of it. Another part is things like social impact bonds. For instance, you also had HDFC mutual fund that had a cancer care mutual fund. All of these are blended finance examples. So we want to be able to help clients make that decision in terms of how do they look at sustainable development capital within their overall pool of allocations. How do you then segregate that out into philanthropic money? How do you segregate that out into impact investments, blended finance investments, and then to be able to really track that impact? And that's what we do at Waterfield. We're a dedicated team which is on philanthropy and impact investing. And we think they're doing an absolutely great job in just connecting the dots between people who have capital and people who don't have capital. And that is what wealth managers absolutely must do. One of the surveys points that came out was that our clients were saying wealth managers don't do enough, and they have to if they really have to make this. If India has to, grow, and levels of income inequality have to be changed going forward.
Fantastic. That's very, very insightful. Thank you. Thank you so much.
It's actually fabulous. In fact, I actually wanted to touch upon a very touchy topic, if you will, which is in the investment management space. Sachin, pardon me for saying that. But in the Indian context, how much headway have passive investments being made in the portfolios? There's a lot of chatter which keeps happening that in the Indian markets, it's too early to talk about passive investments. There's a lot of alpha still being created. What is your view? How are you advising your clients, on this entire thing?
So of course, sitting as advisors, we've always tried to bring down the cost of investments, because I think that's fundamentally one of the things we want to do. And we've been fairly active in terms of propagating passive investments for several years now. Because we always felt that a lot of wealth distribution companies never looked at passive investments because they weren't really getting any distribution fees on it. Whereas sitting as advisors, we could see it and we could actually say, this is an area of investment that you must look at. Today, we would have perhaps about 20 to 25% of our equity portfolios is in passive and passive plus. Okay. We actively encourage clients to go that route. I think what we've also seen is that passive investments have done a lot better. They've, you are at the benchmark in that sense, but a lot of active managers have not been really able to generate alpha. So particularly in the large cap space, we've tended to like the passive investment play much better. When it comes to small and mid caps, we're happy to go with the PMS managers. But certainly in the large cap space, we've tended to go more with passive. I also think that what are the benefits of passive investments? You're actually not timing the market, you are staying invested. You're also seeing the rotation in sectors which is happening, which you yourself may not be able to time. So if something is moving from growth to value and back to growth or otherwise, you're not second guessing the market. You're always invested through the passive place. So I do love that space. I do feel that it's going to come upon us. We already see a couple of asset management companies that are putting a lot of energy behind this. Happy to support them. I also think that smart beta is another area in the passive universe, which is coming out quite strongly. We run in terms of, on an advisory lens, a couple of portfolios for clients in smart beta, just for them to get accustomed to this whole new way of investing, which is also out there for them to dip their toes. And we've had a very positive experience. Clients have had a good experience with that and are more encouraged with it. So this is the future, just as advisory is the future, passive is the future. So it's really a question of how quickly we embrace it.
That's amazing. On this smart beta thing, we actually run a portfolio on the lines of smart alpha, and it's a 12 stock equated portfolio. I completely agree with you. I think a lot more attention and conversation is starting to happen around this. So it's actually a vindication of something which we've been doing. So thank you so much for that. But you talked about impact investing, stroke ethical investing. You talked about ETFs. What are the new investment themes, according to you, which are coming up in this country, the innovation in this thing?
So I think when you look at the newer investment themes which are there, because I think I would look at first, what are the trends? We are clearly seeing technology disruption and innovation across the board. We are also seeing changing demographics, and we're seeing a focus on sustainability. So whether it's through governments, investors, consumers, communities. So these are the three big trends which in some sense are playing out. If I was to kind of overlay these trends with sectors or themes, then I would say potentially the areas that one would look at are spaces like 5G, autonomous vehicles, future of healthcare, robotics, AI. Those are all the spaces that are going to look very interesting going forward. If I was to look at these themes and then say, are there public market equivalents where I can take exposure to these themes? Yeah. They're not there. So that then naturally then comes to the whole asset class discussion of why do I need to be in alternates? Why do I need to have exposure into unlisted companies? It's because you need to take exposure to investment themes that today are not available in public markets. And if they do hit public markets, it's going to be maybe 5 years out, 7 years out, maybe 10 years out. And you may have missed the entire play out of those themes if you're not exposed to alternates. So that's one of the reasons why that becomes an important element within the asset class discussion that clients actually have. So I would say that, we have to be vigilant, mindful, and understand the trends, keeping in mind, the fact that we're going to see changes in the demographics. You are going to see sustainability as a big theme, and you do have disruption coming in through technology across every industry, including our own.
Impressive. Very, very interesting. In fact, before I move on to Sachin, I just want to tell the viewers that we are looking at your questions. In fact, one gentleman has already made a comment saying that can we have this video for future reference? So yes, it will be available on PMS Bazaar platform. But that's still in the future. This is live. If you have any questions, please feel free to ask. There's a prize for the best question. Let it come. Sachin, over to you.
Yeah, sure. So, Soumya, you did mention about, you being an advisory firm, and which is where there is no conflict, right, compared to a distributor. And I completely not only understand, but I can completely relate to it because I'm on the other side of the table. Yes. And of course, you also mentioned about passive the future, which is the threat to my livelihood. I understand that also, which is fine, which is, at least I'm aware and I have to work more harder, which is fine.
I said it was a touchy topic.
No, which is fine. No, I'm happy. So nothing wrong.
Yeah, no, but I did say that we were only going there on the large cap side.
Caps. Yeah. So I understood where I need to focus. So I'm happy to know that. But, like today, when you set up the advisory business, probably you might be one of the very few people who actually thought of that model, right? In fact, the regulations are also now getting more and more distinct about it, right? So I'm sure you faced a lot of challenges on that part because Indian investors or Indian families were not probably used to paying fees. They were rather just used to getting invested. And how did the intermediary earn was never their thought process. So what were those challenges? And if you can also share some successes, of course, so if you can just.
So I'll start with the challenges. So as an entrepreneur, you are always, you start with challenges. Everything starts from there. Right. And particularly because I was trying to define a very new business model. People couldn't understand it. People always kept asking me, is there a double layer of fees? Everyone also said that, Indians don't pay fees. I was also told when I was first starting the company that you will never succeed. It is just, it's literally like a gone case, no hoper kind of situation. And I remember still thinking very, very strongly and believing very strongly that this is the future. I saw the writing on the wall 10 years ago because I just felt that, and this was really coming out from the global financial crisis of 2008, where you saw this proliferation of family offices that got set up in 2008, specifically because they did not like the way in which their wealth management firms were actually handling their money. They had a proprietary book in which they were running their prop book in one way, and they had a completely different view where it came to clients. So when I was reading all this, and of course, being at Standard Chartered, I thought this is the future. It's going to come to India sooner than later. So I should be looking at this because it also then means that you can work more deeply with a family. It's not just about the cursory, the RM would come to me and say, hey, I've got 5 crores from a client. And I would say, you've got 5 crores from the client, but this client is actually worth 500. So what are we saying? The conversation is not meaningful for the client. You will just be another incidental RM to a family, and you will be, in some ways, I hate to say it, irrelevant for that particular family. So all these were playing on my mind. And that's when I said, look, there has to be a better way to do this. There has to be a way in which we can sit on the client side. We've seen everything that happens in the wealth management industry on the other side. And therefore, how can we use maybe a little bit of our inside knowledge to be able to make sure that we can educate the client that there is a better way in which you can make your investments. So the challenges were huge. I cannot even begin to tell you. I almost shut this company 1 year after I started because I said it was just too hard to do this. But 10 years on, I think regulation actually was wonderful in terms of it came at all the right points. And here it is completely serendipitous because otherwise I don't think Waterfield would have survived 11 years on. But the fact that the regulation came as a tailwind in almost of our business is something that has really made a difference. Challenges, of course, apart from the naysayers and everyone else, I think now is still that even the relationship managers today, still in the industry, are very disbelieving that people will actually pay you fees, right? Now, and I feel that some of the best relationship managers are still on the distribution side. They have to come over to this side to be able to actually make a difference in the industry. But maybe they're very well settled, they're very set where they are, they don't want to rock the boat. But I would really say it will just free your mind in terms of the way in which you can engage with the client and the way in which you will engage with the family. And you will realize what a deep and meaningful relationship you can have with a client. So those are the challenges, clearly about people, clearly about the naysayers, and clearly about the industry at large, which I think needs to make that mental shift in terms of advisory. Successes, many. We are, as I think, Vikaas, you did mention, we are one of the best awarded and most awarded wealth management companies in India. But for me, that's not as important as like last week when I met a client, and the client actually told me that, and I was meeting him 3 years after I first pitched to him because it was COVID and we just onboarded him. We were in touch on the phone, but we just never really got down to meeting. And he looked at me and he said, because of Waterfield, because of you, I'm able to sleep better at night.
Wow.
Now, for me as an advisor, there is no higher praise than that. The fact that they can say that they can sleep well at night, knowing that we have done everything that we could in order to make their life a little easier. I think that for me was just ticked all the boxes on cloud nine at that point. So one is just client feedback. What do we hear from clients about what we do and the fact that they like what we do? Of course, the other is just building Waterfield. I have a great team, love working with the team. We're all very passionate about what we're building. We're very passionate about the fact that we're going to redefine this whole space for India and the world. It may take us time, but we're on the path to do it. And that's really wonderful. Just having a great team that you can actually work with. And we have stayed absolutely true to our business model. which is, I think, for me, a great sense of pride and success.
Fantastic. So, just on a lighter note, you did mention about the RMs need to move out from the distribution to the advisory.
Yes.
So, I always think that the kind of the advice that they give to their investors to be long-term, if they also think long-term for themselves, they'll probably move on the advisory side.
Absolutely. And I hope so. And I hope that happens.
Just one last thing from my side. And if I have to turn the tables now, so like, as a family office, if I am, availing services of an advisory firm, how do I evaluate over a period of time? Of course, one thing you already mentioned, if I can sleep well, but are there certain other parameters that how can I evaluate whether is my family office or is my advisor doing a good job for me? So are there something, how does one evaluate that?
So I think we just touched upon this also a little earlier, but it really has to do with, there are some hygiene factors in terms of just performance.
Sure.
Am I, at least in terms of the investment advice, am I really making sure that the performance is better than benchmark? That's one very obvious way in which you look at it. I think the advisor's role is also a little harder, because you always have to measure this over a period of time. I can pitch to you and say that, look, this is all the things I do, but you have to almost have a leap of faith to believe that this is what I will deliver in order for you to come on this side. But the two other things that I spoke of earlier, Sachin, which is really around access. And here it's a little bit more relevant in the unlisted space, because you will find that more and more funds, more and more investment opportunities come to certain advisors because of the model in which they operate. And that is not something which is easily available. So access becomes important. And of course, I will always inevitably lower the cost of investment. So overall, a lot of families and clients don't understand in the initial phases that when you have a return on a product, the cost of investment is coming out of that product. So if you're paying distribution fees, it's coming out of the product. It's not some separate pot of money that you have. So if I'm able to lower that cost of investment, it really means I'm giving the client a better outcome of the return. So which is exactly what you want. You want the client incentivized. You want the fund manager incentivized correctly. So in that sense, I do see this as being extremely relevant. So access, cost of investment, basic performance, and the fourth is probably around just the holistic services that you can provide, because it's not just about pulling the product into the portfolio. It's also about the financial plan, which investment vehicle I've used to make the investment. And then pulling the product and then making sure that the price of the product is actually right when I'm making the investment as well, and monitoring that as well going forward. So lots of different pieces, but it's really about holistic management, and they're being able to really come to us for anything at any time to get a view.
Sure. So I can't agree more. In fact, I'll just add one last thing from my side that, as a fund manager, I would be very happy if I have a client from an advisor, because obviously we're going to charge much lower fees to the client compared to a distributor's client. And of course, my performance looks much better. Right, because it's a much lower fees. So from my perspective, it's actually a win-win-win. It's a 3-win, in that sense, from a fund manager, from an advisor, and for the client. It's a fantastic model. So I can't agree more with I can completely relate to what you said, actually.
Wonderful.
So great, Sachin. As always, questions have just poured in, and there are a few questions, there are a few comments. I'm just going to take the liberty of scanning through them and bringing out the best questions to you, Soumya. The first one, which is very obvious, is somebody's asking, so Ram is asking, is your firm a corporate RIA?
Yes.
In the technical sense, yeah. So there you are. And Ram, if you were looking at the tenets of wealth management, or what Soumya was talking about, this video will be available later. You can have a look at that. Shreyans Jain is asking a very interesting fact point. He says, what are the covenant factors you look in a client before advising them? How do you select a client?
Very good question. Very good question. I have said no in the past. And I think for us, reputational is very, very important. I think for any financial services company, uh, why do we do KYC? Why do we do world checks? It is because specifically you don't want to have a situation where you as a company are threatened because of association with a client who may not be the right profile. This is something that if it is beyond what is our stated parameters, it will come up all the way up the chain for an approval before we onboard the client. Um, I will say that there are some sectors that we have, or segments we've not looked at. I wouldn't really want to publicize that on this, but there are certainly from a reputational point of view, we would be extremely conscious of who we associate with.
Very interesting. So we have Purvesh Dagli who's asking, what process do you follow to exit a sector or stocks? It's a very specific question if you want to answer it, or I can move to the next question.
I think for us, it's really about, and here I will say that most of our work as an advisor is really around choosing the best fund managers. So for us, it's not so much about the direct stocks that we choose. We normally like to leave that to people like Sachin to do in order to find the right exit calls on a stock. We would be more interested in being able to identify the right fund manager. Most of the clients who have direct stock portfolios at Waterfield really are in that buy and hold category. So they're buying the stock to really hold it for a very long time. And we're really not looking at when do they exit that stock unless there's a governance issue or we really feel that, this stock has outlived and, the gains that you've actually made over the much, much longer period than what maybe Sachin or other fund managers may look at. But fundamentally, our job is to pick fund managers.
Brilliant. So Kunal Laljani asked about, what are the sort of things clients expect from advisors. I think that has already been answered. Mohit Madiwala asks a question about what are the key developments you've seen in the private wealth management space, advisory space in the post-pandemic period, and how has Waterfield adjusted, if at all, and kept up with the disruption?
So the good part was, I think, technology, which was huge in terms of the disruption that we saw. You would always think that this is a industry where you have to meet the client in person. And I remember pre-pandemic being on countless morning, evening flights in order to meet clients. That has changed. We've become much more productive in terms of being able to do things on Zoom, reach a much wider audience as well. So certainly from that sense, just in terms of productivity, reach has increased dramatically because of technology in an industry which I think we were all quite fearful that, if we don't see our client, will we lose the connect with the client? And certainly I felt that. Not to say that it's actually much nicer now that we're actually meeting clients in person. And yes. I will say that it's a completely different ballgame, and I'm very happy that we're back to that. But I think that was a big learning for the industry. It just means that organizations like ours can actually reach out to more people in tier 3, tier 4 cities, which we may not have been able to do before. And we were restricted just to maybe tier 1, maybe tier 2. So there are pockets of wealth which are sitting all over India, which we can now access. I think in terms of investment trends, clearly we've seen this whole shift towards passive, which is something that I personally like and we've encouraged at Waterfield. And the other is just in alternative investments, because I think the private markets, there's a lot happening in India. You see the number of unicorns which are being created by the day, unicorns. All these are people who are going to need wealth management services, high-end wealth management services in order to cater to their needs. So it's just an opportunity which is there both from the alternative investment space for investors and for, in turn, the new age ultra HNIs who we can then service in the industry.
There are 33 questions, but I'm sorry, we don't have enough time to ask 33 questions. So I'm just going to pick the last two at my discretion. Sure. And I promise you that I'll make sure that all your questions reach Soumya and, they can be answered. But for the moment, just two last questions. So Mukesh Kumar actually got a little upset. He's saying, asking so many questions, you're not even picking up one of them. So I'll pick up one of them, which I think is more relevant to you. His question here is, if you're working with a wealth management company and banking, we have a lot of pressure to perform in that environment. I'm not able to get the question, how we manage to ask comfortable where pressure is high. I think the question is that when you are in the wealth management business, you're always under pressure to generate revenue. How can you take that pressure, be comfortable, and also be clinical with the client? It's a little bit of philosophical question, but I think
Yeah,
something you may want to answer.
Yeah, so in here, I think it's the culture of every organization. It starts from there. What is the culture of the organization? And one of the reasons why I like advisory, and again, I'll come back to it, is because ultimately the main work that you've got to do is really to convince the client to onboard onto your platform. Because once they're on the platform, they are quite comfortable in terms of what you're doing with them. But it also is annuity revenue for the relationship manager who's onboarded the client. Because the client effectively, as long as they stay with you, is consistently paying that fee. So if you come in year one and you build up your book and your base, then that annuity continues with you in year two and year three as well, much like it happens in distribution as well, because you've got the trade fees.
Sure.
But at the same time here, you're not under pressure on which product to sell, because irrespective of the product, the client is paying you fees. So you can suggest even, I hate to say it, you could even do a fixed deposit, right? And the client is paying you on the AUM. Or you're doing a tax-free bond and the client pays you on the AUM. Or you're doing a liquid fund or an arbitrage fund and the client still pays you on the AUA. So in that sense, it allows you to maneuver in order to create that right asset allocation without the pressure of which product am I in, which subcategory am I in, and you just feel very free. So there is obviously the difficult days of having to put your portfolio together, but once it's in place, again with SEBI regulation, where you have to charge a percentage of the assets that you manage, it then means that as you grow the assets, automatically there is an increase, hopefully, in your fees, unless of course markets tank terribly, but then you're compensating hopefully for AUM growth,
Right.
which is happening on the other side. So much easier an advisory element, tougher, but it comes from the organization. If the organization itself is just driven by quarter performance and pushing RMs to do, push a product. In fact, that's one of the reasons why a lot of people come to Waterfield is because they're just so tired of that constant nagging of, push this product and sell this product and pitch this insurance and do this and do that. And they're not given the freedom in some ways to really engage with their client in a meaningful way that they would really like to.
Interesting. Very interesting. In fact, one of the things which I've realized amongst a lot of wealth management outfits nowadays, just to answer this question from another perspective, is there's a lot of risk management which has now come in, vis-a-vis mis-selling, vis-a-vis a lot of things. So I think, this whole space is evolving so fast and so beautifully. I think it's a win-win for the investor all the way. I'm just going to take the last question. This is from Navneet Ajmera. He's talking about the approximate asset allocation for ultra HNIs. If you can give a ballpark thing across risk profiles, and how does it compare with global benchmarks?
Yeah. So in the Indian context, I think we still have about 60 to 70% in equities. You'll probably have about anywhere between 20 to 30% sitting in fixed income, and then you'd have a large chunk in alternates, which is maybe about 10 to 15%. And then you've got a little bit of cash, if at all, that you're holding. What's interesting is that there is still a lot in the public markets, traditionally, which Indian families do like. If you were to look at global benchmarks, I think you'd see a disproportionate amount which is sitting in the unlisted space. They'd have maybe around 50, 60%, which is actually sitting in private markets. Of course, fixed income was nothing or very, very little because of the returns, but they would still have a small fixed income portfolio. And everything which is really more on the listed equities is really run out of passive investments. So that's really how family offices would look globally as compared to India. So India is shifting. I think we'll see the shift over the next 10 years. because fundamentally family offices and ultra high net worth clients don't need liquidity. You're never really running with a liquidity issue for them. Invariably, they are getting more liquidity than you can handle. And reinvestment risk then becomes a big issue for large family offices. So I would say that you're going to see more migration towards private markets, which are more illiquid. You don't have so much of a reinvestment risk, which are typically 7 to 10 years. That's the way this segment is going to move in the next decade.
Wow. The last time since I mentioned, I'm already at 42 questions. So I'm going to request PMS Bazaar to actually compile all of these questions and please send it across to Soumya. They will come to you with email IDs and all of that. So, please feel free to respond. So there are 3 questions, I think, which you liked. I'm going to ask you to choose the best question amongst them. This was one which I just talked to you about the global benchmarks. This was from Navneet Ajmera. Mohit Madiwala asked you about key developments that you've seen in the private wealth management advisory space and how are you keeping up with the disruption. And the first question, which was from Shreyas Jain. I'm just trying to locate that question. There were so many questions, I just lost it. But you immediately reacted that you liked that question. Let me just see.
Segments we don't do.
Yeah. Correct. So which of these would you want to nominate the best question?
The first one, the segments we don't do.
Wonderful. So Shreyas, I think your question is the prize-winning question. Thank you so much. And the question is still coming. So thank you so much, everybody, for your amazing participation, your amazing questions. And I think it is just fitting that so many registrations and so many people being interested ask so many questions at the end of it. Thank you so much, Soumya. This has been, and I would put it as a masterclass. I'm sure the video will also be viewed by a lot more people. Thank you so much for your time, and thank you, PMS Bazaar. Thank you, Sachin, for this entire amazing conversation. Thanks a lot.
Thank you, Soumya. Thank you for a very insightful session. Thank you.
Thank you, Vikaas, Sachin, Dan, PMS Bazaar. It's been a pleasure. Thank you for having me.
Thank you. So, dear participants, once again, thank you for joining us for the insightful session. Wishing you a happy and safe weekend. Thank you, everyone. This will wind up.
Thank you.